Okay, ladies and gentlemen, if we take our seats, we'll get underway right on time because our next speaker is actually standing by virtually. We don't want to lose the satellite signal or whatever else is bringing him in. Okay, ladies and gentlemen, we'll get underway for our afternoon session. And our first session is entitled, What Do Zero Rates Mean? There was a lot of talk at in the morning around inflation, reflation, alternatives because people are chasing return. They're not around. One thing's pretty clear is that if you're a bond market specialist, you're fully engaged at the moment, looking for value. There's no question. And our next presenter, Charles Jameson, Chief Investment Officer of Jameson Coot Bonds, is one of those folks. He oversees portfolio management for the Australian, global, and absolute return high-grade bond strategies. And prior to JCB, which he formed, he forged a career as a seasoned bond investor from 2001 in New York, Tokyo, London, and Sydney. So he's got very deep experience with some key market players. He knows what he's talking about, and I'm really looking forward to what he has to say this afternoon. So please welcome Charlie Jameson, virtually. Welcome, Charlie.
So we are at zero interest rates, and what does that all mean? Obviously, there's been a lot of discussion over the morning about inflation and inflation expectation, but it's really important and critical time to sit back and think about what's happening in the bond markets. Clearly, after the first couple of months of this year, with the blue wave outcome in the Georgia Senate runoffs, combined with huge amounts of potential fiscal stimulus from the United States, bond yields are moving higher, and moving higher pretty rapidly in expectation of that inflation that will come. But the reason it's such a critical thing to think about, and something that we saw briefly last week, is that this can hugely upset the apple cart in other parts of the asset market complex. And we saw that, I think, on Thursday last week, where a sell-off in US Treasury yields and in Australian yields did cause a lot of issue with regard to markets like equity markets that fell very rapidly. And we know we've had a lot of episodes like this, over the recent course of history. I guess the most famed one was in the fourth quarter of 2018, when the Federal Reserve made some commentary about being a long way from neutral, which meaning that they were going to be hiking interest rates potentially more in the US economies. Clearly, the bond markets didn't like that much and had a big sell-off. And then what happened was we had a period of kind of calm. But what happened is that the high yield bond market started to freeze up, and there was very little issuance in some of those more zombie kind of companies. And ultimately that led to a 20% equity correction later on in 2018. So this can have very, very powerful impacts as it spreads out across the asset complex, because bonds are the virus that affect all things. They are our funding rates, they are our discount rates, they are our risk-free rates of return when held to maturity. And so as this space is warming up, and clearly it's moved a lot already over the course of this year, I think it's fascinating to talk about, because that volatility doesn't stay in one place for very long. And if it does stay heightened, then you should absolutely expect that it will have other second and third derivative implications through other parts of the asset complex. So it's a fascinating time to be talking about bonds. I think it's also important and fascinating to be talking about inflation and inflation expectation. Obviously, as we know, we've had very little material structural inflation in the world for quite some time. A lot of the secular drivers as to what has brought us a highly deflationary environment, they're still absolutely present. So they are, poor demographics, very high debt loads, huge amounts of technology innovation, robotics, automation, lack of unionization, these types of things, globalization in and of itself, have all been eating away at any kind of inflationary impulse. And as much as we have a cycle of inflation, every time we've been rising, we've been making a lower high. And clearly, as we've been falling, we've been making lower lows. So we've been in this broad declining inflationary environment for a long time. And clearly the bond markets and long-term interest rates have also followed that lower And so we find ourselves where COVID is clearly going to change this relationship to some degree. Now, are we expecting higher inflation? Absolutely, we are expecting higher inflation in the short run. In the medium to longer term run, I think that's a really interesting question, and we'll come back to it. But we should talk about the short run of inflation before we get to that. You'll well remember, and it was very painful, certainly if you live down in Melbourne over the course of 2020, but the global lockdown that we went through in March and April of 2020, as we first started to deal with COVID, was a tremendously disinflationary period. We had negative oil prices, so you can't get much more deflationary than that. But inflation is a rate of change function, and obviously, as we're starting to drop the Q2 2020 inflation data and replace that with Q2 2021 inflation data, then the slope of inflation rises massively. And so the bond markets are searching around for what does all of this mean? How are we going to deal with this? Is this sustainable? Certainly, there are a lot of animal spirits that have been caged in the Northern Hemisphere waiting to get released. We know there have been supply blockages through to lockdowns, via lockdowns and the like. So how sustainable is this inflation pulse going to be? It's certainly our belief that we will have mechanically much higher inflation into April, May, before it then will calm down again and settle. But certainly there's a lot of folks in the markets that want to talk about this re-energization of inflation. We have a few issues with that, though. We're really going to need to see material wage gains to find that in a sustainable state. And we certainly don't see that as we look around the labour complexes around the world. The labour markets have tremendous amounts of slack, and a lot of them still coming off what has been really disaster relief funding bridges, which have really managed to bridge that divide between lockdown and some kind of pass through back into the private economy as we try to pull back. We're about to go through that, obviously, in Australia as we wind off JobKeeper at the end of March, and 1.1 million Australians will no longer receive that benefit, and the private sector will need to stand on its own 2 feet. But notwithstanding that, I guess, the expectation is that bond yields certainly have moved higher. They might have a little bit further to go before we find that peak where we get that maximum inflation kind of push. But the reality of it is that we just don't foresee a sustainable inflation push because economies have a huge amount of spare capacity. And so we do expect any of those supply blockages that have been in the system to be easily absorbed once, the Northern Hemisphere in particular can get back out and get productive. Capital remains very, very cheap. So we don't expect that to be an ongoing issue. But it does bring us to a really interesting kind of phase in the market development because clearly risk-free rates are rising. We're still in an environment where corporate credit is more expensive than it was going into the COVID experience. They've absolutely loved all of this kind of governance sustenance which they have received. But as I said, we can't have a system where a sustainable state where we have volatility in the risk-free asset class that is likely to not move forward into other asset classes. And so that's where this becomes very interesting. I might actually just get you to jump forward to slide number 6. We'll have a look at what happens after these episodes and why it may very well be that the major issue for recovery, just one slide further forward if possible, is going to be very important to monitor as we come out because it's going to start to affect the valuation of all things. I think the markets in terms of the bond market performance last few weeks has certainly been fishing around for how big will Biden's fiscal stimulus program be. The US economy in general is running pretty well. The COVID relief bill is brought to pass by a reconciliation process. But a lot of that relief, which is actually tabulated, isn't really about COVID relief. It's about further economic stimulus. And the real danger is that the US can overstimulate their economy in this regard. So, Australian interest rates do follow US interest rates very closely with a very high correlation. And so what we're looking at here is periods where the bond market has performed poorly and what happens thereafter. And it's that linkage as to what happens thereafter, which is really worth thinking about, particularly as you think about other asset classes in your portfolio. Because as we said, interest rates are the virus that affect all things. And this is why this becomes very important to monitor, because if we are to have a further increase in interest rates, it can bring obviously sufferance into other asset classes, as we've seen previously. this is a rubber band that can only be pulled back so far until it does snap and can become quite problematic. What we're kind of seeing here in a more traditional cycle is that generally when bonds do poorly, it's because central banks are raising interest rates. And so in 94, that was absolutely the case. 99, coming out of the GFC, and thereafter clearly into a higher funding cost, given that we've got pretty large debt burdens in the world, never larger, now than we have in previous cycles. The economy tends to slow down, and this is where we struggle to achieve what we call escape velocity. Because we're very heavily, debt burdened and very interest rate sensitive, a rise in interest rates becomes quite problematic on a forward and sustained basis. And so generally what happens after these types of products like risk-free government bonds underperform is they tend to perform really well in the years following. And we're just going to run you through some of the mechanics as to why that is, because it's fascinating to look into how does this all come together. I might just get you to come forward one slide, and we'll look at some of the kind of breakdown as to how these returns come about. I think if you ask 99 out of 100 financial professionals what has been the major driver of bond return in the last decade, they would all say it's been duration. And they'd be partially correct. In fact, if we're looking here at the US Treasury complex, has a total return over the decade of around about 48%, but only roughly 20% of that move is attributable to duration, which is it's actually very, very small, given all of what you'd mainly hear about around duration moves. And clearly duration moves bond prices in the very short run. But through time, what you really want as a bond investor is you want high incomes to start with. That's a great thing to start with. And then you want a really steep bond curve. And so take you all the way back to your economics degrees back at university. We're talking about the term structure of interest rates. And clearly when we have a steep curve, that means that bonds can what we call roll down that curve. And so I'll give you a very simple illustration of that. If we have a 50 basis point yielding 5-year government bond, but we have yield curve control set by the RBA at 10 basis points at a 3-year point, well, then unsurprisingly, as that 5-year bond becomes a 4-year bond in 1 year's time, assuming that those controls are still in place, it's surfing down the curve and is going to have a yield of roughly 30 basis points on its way to having a yield of about 10. What happens in that process is the bond actually has a capital accretion. So not only is it earning income, but it's earning an additional kind of capital return by virtue of the way that it slides down the curve. So it's the steepness of the curve and the starting income, which is the major driver of bond return over time. And I think, as we're all sitting here, no doubt the sell-off of the last few months will rattle out some speculative investment in the bond market. It is a financial marketplace. It certainly doesn't move in perfectly straight lines. But the thing about if you're building, retirement or investment portfolios for longer tenors, clearly this is an incredibly powerful part of the complex and something that probably isn't discussed enough. But given how steep global bond curves have become, this is something that is absolutely on your side. So, as much as being a bond investor, you might have been hurt in the last few months, on a go-forward basis, this is completely reset. And this is quite unique to government bonds in particular, given that they are a continuously compounding government-guaranteed asset. Certainly, they can have these moments of slippage, but thereafter, the go-forward return profiles look incredibly powerful. And so this steepness of the curve and this rise in yields is certainly something that you should be excited about. Now, that's not to say that today is the perfect day to invest in these types of securities. But what is interesting, of course, is the relationship that this can have through to other marketplaces. As we were saying earlier, with very high inflation expectations and the highest inflation prints still yet to come, there's every chance that bond yields can push a little higher. Now, there is a limitation to how far they can go, certainly versus the RBA cash rate. That relationship is already more than 2 standard deviations cheap. So we are getting into an incredibly cheap, kind of statistical complex versus RBA cash rates, unless you believe we have a huge economic recovery and the RBA can turn around and hike interest rates very quickly. That's certainly not what the RBA have told us. They've told us that interest rates will remain low for a very, very long time. They've upgraded their own QE programs to try and keep interest rates low. and that financing capability very generous to encourage investors out and to push into riskier assets and to explore other income opportunities. Of course, the thing that's most difficult about zero interest rate world is that starvation of income, whether that be in government bonds, in corporate credit, as we said, credit spreads incredibly tight and low underlying government bond yields, all the way through to dividend income. Dividend income has obviously been very volatile over the last 12 or 18 months, and capital prices have been very high in order to receive that income. So a rise in bond yields can certainly have a little bit of a tourism effect between the asset classes. If people can receive government guaranteed continuously compounding income, so if bond yields are to rise quickly, well then clearly other parts of the asset complex come under sufferance because people want to move on. They're not happy clearly with lower yields, as much as the yields might be higher. Clearly for the additional risk that investors bear, they would prefer to have a slightly lower return with less risk. Let's not forget, of course, that government bonds held to maturity have no volatility at all. Clearly, they have mark-to-market volatility on a daily basis. But if you are a buy and hold investor, then the volatility of these instruments is zero, as long as you believe the government will exist to repay you on the maturity date. And we certainly hope that in Australia, that's absolutely the case. So kind of looking through to the opportunities, I guess, in fixed income markets, certainly, there has been huge rise in a lot of other product development, and this huge rise in things like private debt instruments, which are no doubt causing a lot of change in asset allocations. These are all fantastic investment opportunities, but clearly cyclical in nature. I think one thing that's drawn folks to things like private debt is that without that constant mark-to-market, the observed volatility can be much lower. But it's also really important to think through and remember what role do fixed income play in my portfolio. It can play a whole number of roles. It can be income only. Sadly, the world over, where we have very low cash rates and very low bond yields, that's very challenging. It can be a combination of being a defensive anchor in a portfolio, providing some income, clearly enjoying good capital gain when interest rates fall, or we have these periods of tremendous risk volatility or risk concern, all the way through to just being a hybrid of all of those types of things. And we've certainly been a very big advocate, as much as we run a government-only bond business across both domestic and global solutions and an absolute return solution. We firmly believe that investors should use the full gamut of income products that are available. But we might just highlight a couple of things to think about in that. If I could get you to come forward a couple of slides, just to have a look at some of the evolution of particularly the corporate credit market since the financial crisis. Clearly, the financial crisis was, the solution was one of financial repression, starve investors of yield the world over and encourage them out the risk curve. And that worked tremendously well. We had, fairly benign environment, very weak economies. But in terms of financial market returns, it's absolutely spectacular because everything that was low quality or illiquid got a bid. Clearly what used to be a risk-free with some returning yield asset, those yields came right down, and many investors moved out that kind of risk spectrum and right out into investment grade, all the way through to high yield or some of these emerging market type structures. So the major thing that I think low rates has brought to the fixed income complex is a lot of tourism to where our portfolio allocations would have been, say, 10 or 15 years ago, where they would have been much more pure in nature. And that is really, really important when we think about episodes like March and April of last year, or like the fourth quarter of 2018, because one thing that you probably want from your fixed income allocations is optionality. You want the option to be able to use this ammunition storage to get to deeply discounted growth assets in those moments where there is a lot of money to be made by tactical or dynamic asset allocation. I think last year was a perfect proof in point. A lot of these kind of corporate type structures or fund structures that commingle corporate credit with sovereign bonds had intense liquidity problems and couldn't service redemption easily at a time when clearly, equity markets were incredibly depressed. And if you could pass the markets easily on those days, then, clearly, as we sit here today, you've done incredibly well. Other people use things like hybrids. Again, a really interesting product, in a benign environment, good product, but under duress, very illiquid, and pricing can be quite gappy. So we do think about that. As much as there is a lot of opportunity in some of these other instruments, it is cyclical opportunity. Obviously, when credit spreads have widened tremendously after they had in April of last year under intense duress, credit funds had terrible drawdowns and a lot of them froze up and couldn't service redemption. Well, clearly that widening and that re-establishment of value in credit is something that's pretty investable. As I said, right now, the opportunity doesn't seem as prevalent. Those spreads are now tighter than they were in a pre-COVID environment. And so we kind of look forward to the future and say, well, with materially rising risk-free rates that's occurred over the course of the last 2 or 3 months, that puts a lot of pressure on spreads because spreads are a function of the risk-free rate. To give you a really simple example, if we have a BHP bond, let's say, that's got a 5.5% yield and a government bond that has a 5% yield, well, then clearly the market is ascribing a 10% credit premium to the return of that capital for the different credit quality between the government and the very high-rated corporate. If the government bond goes down to a 1% yield, the BHP bond doesn't stay with a 50 basis point spread. That spread will contract substantially, and that's exactly what we've seen over the course of the last decade or so as yields have been falling. Corporate credit's done really well, and it's been very well sponsored. But just fast forward into the future, if we do rise that risk-free rate again and those government bond yields rise materially, that means that those corporate spreads need to probably widen at some stage as well. Now, the thing that we know about corporate credit markets is that is very unlikely to be a nice, simple, linear widening. It's very likely to be chaotic and quite destructive. And so, as I said, we've seen these periods. We saw them in March and April of last year, in the fourth quarter of 2018. When they do come along, they are a huge crescendo moment. And so we do worry about that as we think through fixed income opportunity in this kind of complex. Certainly, with a lot of sponsorship from governments and these huge programs, there has been a wonderful bid for some of these assets and they've done really well. And if you look at their volatility over the March-April period all the way through to now, you'll see that the vast amount of any kind of distress that was occurred has been restored. But it's really difficult to see on a go-forward how they will perform anything like they've done in the last, say, 6 or 12 months since they've enjoyed that recovery. With regard to fixed income portfolio construction, I might just bring you forward again a couple of additional slides just to highlight a few trends that we're certainly seeing in the industry and certainly things that have occurred as a result of very low interest rates. Whereas when we started our business back in 2013, 2014, the fixed income was a bit of an afterthought for a lot of portfolios. It was a bit one size fits all, jack of all trades. A lot of the portfolio funds that were available by the legacy of having a very small fixed income market had an awful lot of product in them, all the way through from government bonds, corporate credit, sometimes a little bit of high yield, sometimes a little bit of currency allocation. But certainly as the fixed income markets have grown and grown, and we now have an immensely large fixed income market of well over $1 trillion in Australia, remembering, of course, that global fixed income markets are 3 times the size of global equity markets, so absolutely enormous. A lot of the things that we've noticed from overseas markets, a lot of the product design is starting to make its way out to Australia, which is a great news story for investors. It gives you, investors and allocators, a hell of a lot more product to choose from, off the shelf, to say, I want a bespoke solution that focuses in on private debt or inflation linked or government sovereign only or floating rate credit. There are all of these different types of solutions. And I think that's really interesting because whereas people would look at this as maybe a singular and somewhat lazy allocation, particularly when yields were much higher, now we're very focused, I guess, on running our own sleeve inside this space, as many other managers are, trying to generate alpha in our own subset within the asset class and trying to compound that all together as a portfolio construction for really powerful outcomes over time. So I think that's a really exciting development and certainly something that low rates has only, I guess, fostered in terms of bringing that additional product development to market and allowing investors such as yourselves to be able to have all of these choices, to pull the different levers depending on which part of the cycle we find ourselves in. As we sit here right now, clearly, bonds have cheapened a lot. That's occurred. We know why that has occurred. I guess there's a whole raft of things to think about with regard to our outlook for the domestic economy, We're still coming into winter, which has been a really challenging period for the Northern Hemisphere with its own COVID fight. Hopefully we can get enough people inoculated so that we can get through winter without material lockdowns. It's certainly something that us down in Melbourne here, fear this kind of stop-start economy. And hopefully we can, transition off JobKeeper and some of these other things. But I guess the big, euphoric relief of Melbourne coming back online, 25% of Australia's GDP, a lot of that's actually already occurred. And so if we do look at the forward surprise data for the domestic economy, it's already starting to slow a bit. So we are coming into this incredibly interesting period, as I said, because there's no question that via what's occurring in the US Treasury market, which does lead most markets, it looks like we're about to pass this enormous stimulus package, potentially overstimulate. And of course, don't forget, fiscal stimulus is in itself a rate of change function. Once you spend a lot of money in a particular year, if you don't spend it in the following years, well, then you have tremendous deacceleration in growth. There's nothing more permanent than a temporary solution, as they say in many financial markets these days. And so these temporary programs, as we've seen with multiple rounds of quantitative easing and the like, can stick around for a very, very long time. There isn't a sovereign nation in the world that started quantitative easing that has managed to extract themselves from it in full without having to go back in. So lots to think about, but certainly I think from an asset allocation point of view, that mechanical rise in inflation in the very short term is something that must occur. It will occur. What happens thereafter, we actually think it's going to fall quite substantially because of these powerful secular disinflationary forces. But that's going to cause all kinds of opportunity and threat for markets. Clearly, big changes in growth versus value and in our own space in terms of what our expectations are on the go forward for fixed income product. But it's the restoration of that yield and the steepness of the curve, which we're very confident will deliver good returns going forward once we get to that inflation peak, be that sometime in the second quarter. I might leave it there for now. Thank you very much.
Thanks very much, Charlie. I think that was excellent. It's a challenging session right after lunch. I don't know. I've seen a lot of sessions on bonds, but that was a really interesting journey through a lot of content. So thank you, Charlie. That was great. I'll pass to the floor. Are there any questions?
Yeah,
questions that people
are there
have got?
questions?
There's a lot there, and I've got to say, I wrote some of Charlie's terms down because I'm going to use them. Escape velocity was interesting. We've got a question down here on the left.
Hi, Charlie. Michael Kennedy. Great presentation. It did give me a bit of thought about obviously, as a bond allocator, thinking, what's going to happen as interest rates go up. But if some of that has been priced in and you've got the ability to run off those rolls and make sure you're pricing them through, as we go up higher into the risk spectrum and beyond the government bond side, and how some of that spread hasn't yet seemed to have affected some of the other credit markets. I guess what you're implying at the beginning of the briefing was that there is yet to be and soon will be perhaps a dislocation in other asset markets when it comes to that.
Yeah, absolutely. So the one great thing to remember here is that markets are primarily driven by flow. So, if we do get to a period where, let's just hypothetically say, bond yields rise too quickly, and that causes other risk market participants to get some anxiety about that, how does everybody who's universally long the credit market get out of that trade? Who is the marginal buyer? Everybody, it's a similar kind of situation in equity markets. There is no one left that is universally short and hanging on. Everybody is pretty invested. The shorts have kind of been taken out the back and their P&L has been destroyed. So we get this very unbalanced market. And I think that's what's really interesting about 2021. People have, almost certain conviction that it must be a great year to be an investor. And the irony of that is that it might very well be the recovery in and of itself, which is really negative for risk markets. Risk markets clearly have diverged tremendously from economic outcomes because they love liquidity and they love these emergency programs. If we are to recover and we are to take that emergency function out of the market a little bit, then does the market look over the hill and say, gee, I don't really like what I see on a go forward. I was much happier when central bankers were soothing me to sleep every night. That is in and of itself a really interesting kind of concept, because certainly as we look at 2021, it's really easy to build a case to be incredibly positive for risk assets. They're lower for longer. Central bankers are at the helm. They've got their hands on the wheel. They're going to land this plane and get off and let it cool down, and we'll be able to jettison all the way through the COVID recovery. That's the nirvana kind of extrapolation of that. The other thing is that the bond market tests central bankers, and certainly that's roughly what we've been seeing when the Democrats want to spend $1.9 trillion. That money has to come out of the US Treasury market, and Treasuries are backing up saying, if I'm going to lend you $1.9 trillion, I'm going to charge you more. I think that's pretty rational. And certainly with the spending that's going to occur, is that going to jam up inflation even more so? We know that we've got mechanical rate of change inflation. Does that cause inflation to hang around a little longer? And then central bankers have told us, well, we know what happens if it becomes too hot, we can slam on the brakes. They say we have the tools to control this. Well, then how do risk markets respond to finding themselves in not only a declining liquidity environment, but a rate hiking environment? I think you can forecast a pathway forward where risk assets don't like that too much. So it's all about confidence, though. And I think this is the swing factor that people often forget, particularly in credit. Credit, I guess equity investing is about confidence, but credit is really the confidence market, because there's so many of these kind of corporations that are zombified, require constant funding on a rolling basis. So they're not all borrowing money for 30 years to run their zombie businesses. They're borrowing in much shorter timeframes. And very much like the Eurozone sovereign crisis, if the markets decide, I don't think you're an investable credit anymore, I'm not going to roll you forward, i.e. I'm not going to re-lend you the money that I've already lent you, and I'd like to be repaid as well, we have the tremendous bottleneck in the markets. And that's really what we saw in 2018 in that fourth quarter. The inability, there was not a single high yield bond issuance for 6 weeks after the Fed made that statement and clearly pushed too hard in terms of a hawkish kind of narrative for the market. And it was the complete freeze up and bottleneck of those corporate credit markets that ultimately brought tremendous demise to the equity markets, forced Chairman Powell at the time to become patient. That was his terminology shortly after, on the 4th of January. And he was cutting rates again 7 months later. So the central bankers need to be very careful here, but certainly as this volatility has been rising quite tremendously in the government bond space, we do expect that over the course of time it will jump asset classes, and you should expect that it will have other implications around the system.
Other questions?
No, look, I think we'll leave it at that. Charlie, thanks very much. That was an excellent presentation, as I said. And if you guys thought bonds were interesting, Charlie, I think you've repositioned it nicely. So please thank Charlie for us.
Thank you very much.
Okay, we'll move on to our next session. Again, being deliberately provocative, we're at an Institute of Managed Accounts professional session, and the question that's being posed is, do managed accounts work? I think I know the answer to that, so we're going to have to, apart from yes, we're going to have to move this along, Toby, and I'll get you along to moderate the session and introduce presenters.
Thanks very much, Al, and I'm sorry to reappear before you in a different guise. Brett, if you'd like to join. Now, we have 3 presenters for the session called Do Managed Accounts Work? So Brett Sanders from Philo Capital is joining me on the stage. So disclosure of interest, Brett and I are business partners in Philo Capital. So everything he says, you should believe in. No, anyway, disclosure of interest. But joining us also remotely, Jason Comodina from MLC, and I'd like to thank Jason for stepping in at the last minute with the demise of his former colleague, and Rob De Silva from Sqm Research. Now, I wanted to ask this question of, do managed accounts work? So, Toby, we don't have a slide, do we? No? Yes or no? Right. Okay, let's go back a couple. Right. Do managed accounts work? And I want to pose this question to you, which is do managed accounts work? Compared to what? solving what problem, for whom, over what time frame, how do we measure success, and what are the trade-offs that are involved in making them work. So I've posed to our three presenters this question of do managed accounts work. So MLC represent one counterfactual, which is they are both a unit trust manager and an SMA managed account provider. So from Jason, we'll see this issue of unit trusts and managed accounts. From Brett, we're going to hear about the issues of managed accounts versus a different counterfactual. That's the counterfactual of, oh, well, if you don't do it through a managed account, well then that's the advisor's job to execute. And then finally, from Rob, we're going to hear about the research process around managed accounts. So how do we assess managed accounts? We're now, managed accounts are now an established financial product. So now we're going to hear how Sqm go through the traditional research and analysis process. Then when we've finished the presentations, what I would like to do is have you involved in answering the question really collectively. Well, if I'm an advisor, if I'm working with advisors, what would it take for me as an advisor involved in the process to know that managed accounts are incontrovertibly working in my practice? So let's spend a few minutes at the end just trying to think through this, the answer to this question, do they work, in a personal, in a sort of personal or commercial sense. So without further ado, what I'd like to do now is hand over to Jason Comodina from MLC to talk about managed account strategies from MLC's point of view and MLC, managed accounts compared to unit trusts. So Jason, thanks very much for joining us. Are you on mute, Jason, or are we on mute? Have we? Right. What's happened to our? That is the phrase of 2021, isn't it? Are you on mute? No. Yes. Yeah, there's all. Yeah, it's okay so far. Yeah, that's right. Shall we see if we can get Rob up, and if we've got, we're okay? Right.
Hey, can
Rob.
you hear me?
Yep. Okay, we can hear you, Rob. Right.
Perfect. All right.
So let's go to let's go along through the slides. The quick preview of the slides.
I think I'll do my presentation rather than MLC's.
Yep. Right. Rob, over to you.
Thanks very much, Toby. Always love a last-minute switch in order, so that's all good. Look, I'm just going to run through kind of the way that we look at. We rate a few multi-asset SMAs. In fact, they're probably one of the fastest-growing parts of our business recently, reflecting the general market trends as well. So I'll just go through the basics of all of that. We don't have a lot of time, so we'll really cover it probably in a high level without a lot of detail, but happy to answer any questions. And just, I've got some numbers around performance of SMAs, which not really conclusive, but are interesting to look at. So if I flick to the first slide, the key task from our viewpoint is to, what people are looking from us as an opinion about the investment competence and the quality of the investment manager, but not just in isolation. It's their competence and abilities in terms of how they can deliver the risk and return objectives that they're telling their clients about in the PDS or whatever offer document they have that's reflecting to their clients, this is what we're going to deliver you. Normally it's couched in terms of risk and return in some framework. And so we're trying to get a sense of how confident are we in their ability to do that. So it's not just it's not a beauty parade by itself against other managers, but we do measure that. So you'll see the rest of the slide talks about some of the key areas that we look at. So we benchmark the investment performance of the product and the risk metrics against industry peers and market indexes. So in the multi-asset space, Morningstar have some multi-asset market indexes that are quite popular. The other often used benchmark is CPI plus something. So you'll see we've got that in our performance slides later on in terms of looking at those performances. Very importantly is to evaluate management capabilities. And here we're talking about two key elements. One is executive management. How do we run the business of a fund manager and keep it sustainable and growing and meeting clients' needs? And of course, the important other aspect is the investment function. Within the organisation, there's an investment team and support mechanisms around that team that are designed to deliver good risk return outcomes to their clients. So we want to look at both of those elements. And of course, the stability and sustainability of the organisation itself, because there's no use in having a great product in a business that it's going to fail. So we need to feel confident about that organisational stability. So in that process, we review the structure and the ownership of the manager, and we look at organisations both gigantic in size, spanning the globe, multi-billion-dollar operations such as State Street and Capital, etc., to much smaller, localised dealer group or other planning group operations. So we've got the scale across the board, and we want to understand the structure and the relationships within those organisations and how they fit together. If there's a responsible entity involved in the process, in the product, then we want to have a look at that as well, because they're a key plank in the risk management of the whole operation. And so it's important to understand how they operate, where they fit, what the qualities of that organisation is like. And of course, in all of this is looking at the manager's business goals and commercial plans. Where do you see yourself going? How are you going to improve your market share? What things do you plan to do to increase engagement, grow FUM? There's 100 questions you can ask about those business plans and how the manager sees themselves moving forward into the future in a positive way that benefits everyone, but particularly the clients, obviously the investors. So if we look at the next slide, I'll just talk about the key fundamental factors. What makes a manager competent at what they do, and what factors combine to create a good product that's going to deliver the returns that investors are looking for. So again, some of these things I've already mentioned. The business profile, so the corporate health of the organisation. You want to see that it's got a strong balance sheet, that it's profitable. That's not in a it doesn't. It's able to support itself. In early days, obviously, when we look at boutiques, one of the key areas, the smaller operations, what we need to understand is how are you going to support yourselves to the point where your own cash flows are sustainable and able to support the business. Is it equity injections from partners? Is it borrowing? Where are the support mechanisms? How healthy is the balance sheet? What's the commitment of the people who are investing in that business and holding that business together? What sort of resources does it have that it can apply to the task of of running portfolios and managing its business. And what are the prospects for that business? Has it been growing healthily? Is it moving into sectors that have got good growth prospects, etc.? And that, of course, feeds into product strategies and marketing capabilities. What products have you got on offer? Is it a broad range of products and which serves a large market, or is it a more niche capability that's particularly targeting certain market segments? And have you got the marketing capabilities and resources to address that properly? Whether it's people on the ground in the form of BDMs or someone to manage social media presence, which can be quite important in certain managers. And so those elements are very important to getting an understanding of how that business is progressing. And as I mentioned, the oversight and management of the firm, corporate governance and compliance and risk management, all of these things feature in good executive management. You want a team of people who understand the importance of making sure that the governance relationships are strong, that you are meeting all your regulatory obligations, that you're meeting all your compliance obligations, that you're managing the risks of the business and of the investments in an appropriate way. So those elements rely on a strong management as well as strong investors. So it's not just the case that you have great investors, you'll have a great operation. Of course, that's important, but you need the combination of great executive management as well as great investors within the firm. So obviously, the investment team, who leads the team, what are the qualifications and history and experience of the team? How do they operate together? What's the internal dynamics of the way they work? Is it a competitive environment, a collaborative environment, a high performance driven environment? There's lots of different ways to operate, and none of them are necessarily the best. They may work for one team and not for another. So you really need to understand how that is working in that particular firm and look at the results to indicate whether it's achieving what it needs to and that it's working well. And the investment process obviously is very key. So the logic of the process, what sort of inputs are coming in? Is it just internally driven research and thinking, or are things being drawn from other experts outside of the firm? There are multiple layers of trying to triangulate valuations and other things that are important in making specific investments. How does risk factor in? Is it at the top on the overall portfolio, or is it at the individual security level, or both? These things are very important to understand. They apply to every, whether it's a managed account or a managed portfolio or an ETF or a LIC or whatever. All of these things really apply very strongly across the board. And so the package that the product comes in is an important item, but it's one of the items. These other things that we're talking about are very key in terms of the ultimate success of the. Someone hit page down before I was ready. I can keep going. Investment liquidity and portfolio turnover, a key part of the operation as well. So in terms of the portfolio itself, how liquid is it? Having illiquid assets is fine because you can earn an illiquidity premium, which is quite handy in terms of returns, but also it can be difficult in terms of when you want your money back, if as an investor. So, that needs investigation. Portfolio turnover can influence trading costs and expenses, which can be a drag on performance unless it's obviously highly profitable types of portfolio turnover. And obviously we're looking at performance, investment style, market conditions, and outlook in trying to get a judgment of what the prospects of the thing looks like. And finally, but certainly not leastly, management fees and any other expenses that are involved in the process, need close attention. Obviously, everyone's looking to get costs down. That's been a trend for decades now, and it's still a trend. And in the managed account space, there's opportunities to keep costs down in a very healthy way that it, helps investors and managers, etc. Here we're talking about our own, the Sqm Rating Scorecard. So I'll just quickly mention we have a 5-star system. We score managers on a 37-point checklist, and we score each of those points on a 5-star. And then various weights are attached to those 37 different items. And those items fall into the categories that you see on the slide. So you can see there that these are the things that we think are important in making a judgment about, a good manager and a good product. And so you take a weighted average of all of those 37 star ratings and get the ultimate rating. We apply a quarter of a point flexibility either side of what the rated average is, just to reflect that nothing is always encapsulated in one single number. You need to look at it holistically. So what do we think? We have a 20% weighting on governance and business. We have a 25% weighting on people. So you can see that alone, those two aspects, people and governance, which encapsulates compliance and risk management, things like that, is almost half the rating. The product features, and obviously in managed accounts, the features that are relevant to them will factor in to this element, 15% of the overall rating. Risk and return, you may be surprised, we weight that at 10%. The other elements, if they're all in place, risk and return will kind of take care of themselves to a certain extent. That's not to say we completely ignore it when things are terrible. If there's a dramatic drop in performance, then it's going to have more than a 10% weight there. The philosophy and process is around 20%, and portfolio construction, which in multi-asset portfolios this must be the wind-up signal that my slides keep going ahead of what I'm saying, so I'll speed up. The portfolio construction element is very important in multi-asset products and in managed accounts. So here's a snapshot of performance, 36 SMAs that we have in our database, and I've compared the 1 and 3 year returns to the end of 2020 to those Morningstar benchmarks and to the typical CPI plus 2 or 3 or 4%, etc., that are typically assigned to those risk buckets. Now, I won't go through all the detail of it. It's safe to say, if you look at the last two columns and look at the red numbers, which are underperformance, and the blue numbers, you can see it's a bit of a mixed bag. This is early days. Managed accounts have been around for a long time, but they're really have been blossoming in the last year or two or so. And so it's a little bit early in its development. And so you see some quite, mixed results. You see some outperformance, but a fair bit of reading. So it just says that relative to these objectives, the early signs are that there can be, some improvements. The last slide, though, is interesting because here we're looking at managed accounts in the multi-asset space versus managed funds in the multi-asset space. And here is an interesting picture because you see on a 3-year record, in most cases, the SMAs are outperforming their managed fund equivalent. Not as strong in the 1 year, but 2020 was a very tough year, so it's not surprising there's some mixed results there. But certainly on the 3 year, it's interesting and encouraging, I guess, particularly for managed account operators to see that on average they seem to be doing quite well versus the fund area. So I think that's my time. I'll leave it at that, and hopefully Jason's sound problems will be solved and we can move on. Thanks very much.
Okay. Thanks very much, Rob. Now let me just go back a couple of slides and welcome Jason Comodina. Jason is a Director of Managed Accounts at MLC Asset Management and responsible for their managed account strategies. So if we get the slides back on screen, guys, so let's just go back to start of Jason's slides. Jason, over to you for your 10 minutes on the the compare and contrast funds and MLC managed accounts. Thanks.
Great. Thank you for the introduction, Toby. Hopefully the sound is now working and we've got the gremlins out of the system. Fantastic. So maybe if you bit of a setup, you could flick through to slide 3. The first one is just my name and then a disclaimer. So MLC's been building portfolios for clients and advisors for over 35 years, and as one of the early adopters, pioneers of multi-asset, multi-manager investing in the country, we've been doing it for a while, and historically that capability has only been accessible via my managed funds for a variety of tax structures, be they investments, investment master trusts, wraps, super funds, etc. We've been working for advisors over that time and believe in the value of efficient investment implementation. And that was one of the underpinnings of the original multi-manager series Horizon back in the day. But as new technology has come along, we also understand that a managed fund is not for every client and every advisor, depending on the kind of experience they wish to give their client base. So the benefits to a managed account, giving the more granular look through and transparency, plus other opportunities to advisors' clients, we think is important. We've sort of been watching the benefits of the development of the space, particularly the administration capability. So as the early administration capability was really more focused around equities and listed investments, we didn't think it was really suitable to be able to bring the full weight of what MLC Asset Manager can bring to bear in a managed account into that structure. But as that's broadened out to be much more multi-asset friendly and using a variety of different underlying vehicles, we're now kind of at the point where we believe it can be done. So we've launched a managed account series. If you want to flick forward a slide, please. So MLC has a very clear investment philosophy, investment approach. Believe in diversification first and foremost, across asset class, within asset class, across managers, across different types of investment risk. And I won't belabor all these points, but I think it's just an important setup for the next little bit. We all know asset allocation drives the majority of your return. So being able to actively asset allocate and pull levers in that, we believe is very important. Research-led. We want to understand what assets we're putting into clients' portfolios and what expectations we have for those. Are they meeting those expectations? So proprietary research is an important part of our process, and a focus on are we getting paid for the risk we take. And it's the underlying risk, not just the headline piece of it. So moving forward again, how do we do that? We have a portfolio construction approach we've named the Investment Futures Framework. What it really boils down to is we don't believe that we know what's going to happen in the future. The future is uncertain. We actually don't believe anyone knows what's going to happen in the future. So we look at a variety of scenarios and what we believe will occur. Some are forward-looking, some are backward-looking. How will markets react? How will different asset classes react in those scenarios? And then we look at the probability of each of those scenarios happening. And that helps us put together what we believe are very robust portfolios around that. So I want to focus more on managed accounts rather than how we put portfolios together. But that was kind of an important setup, because the so what to this is when we took our capability from being in a managed fund format to a managed account format, the first question we asked ourselves is, can we build an appropriate managed fund that is true to label for what MLC Asset Manager represents and how we believe in portfolio construction and clients' portfolios? And as we look through that, we sort of thought about a few key things that were important to us. And this is not an exhaustive list, but it gives you, some idea. We'll look beyond simple growth defensive or equity bond splits, but how can we implement our views on FX in the portfolio and being able to move that appropriately? How do we implement our view in duration in the portfolio and have that expressed in exactly the way we want to have it expressed? I think that's an important part of what we bring to the table. And how do we get exposure to appropriate alternatives and diversifiers in the portfolio that give a different risk outcome to clients? As we work through that, we came to the view that the answer is yes, but it'll be different. So if we flip forward one more slide. And this is an example of one of the managed accounts we run, which is the MLC Premium Model Portfolio. I believe it's the Balanced Fund, Assertive Fund. It's a Moderate Fund, sorry. The first thing I'm saying is a managed account is not going to be the same as the underlying managed fund. So our Premium Model Portfolio series or managed account series is stylistically looking to MLC Horizon Managed Fund series. So we're looking to achieve the same kind of things, and we've got the same team with the same underlying investment philosophies and processes running it. but it will be different. Similar, but different. We're inherently limited by the capabilities of the platform. So particularly the investment menu and the kind of underlying building blocks we can access in that investment menu. So the manager lineups for each of the asset classes will be similar. There's a high level of overlap, but not identical, because some of the investment managers we can access in our managed funds, which given MLC size and scale, can be accessed anywhere in the world. We're limited to managers that have a domestic vehicle in Australia, forever a fund, an ETF, or any other simple vehicle to access that capability. So leveraging that research, but where needed, tailoring the managers that we can access. Because of the transparency of managed account, we also don't want to overwhelm clients with a list of 50, 60 managers in there that we have in Horizon, for example. So it's a more concentrated list of managers for each asset class. The asset classes are also slightly different. So we're still trying to express the same asset allocation view, but doing it in a slightly different way. So for example, one of the benefits of a managed account now view to clients is the opportunities for effective tax management, particularly for direct securities and Australian shares. So we want to have a fairly sizable sleeve of Australian shares, particularly for large cap, to harvest dividends, imputation credits, and that tax management opportunity for advisors. So as such, we'll build that Australian equity sleeve slightly differently, different managers, but also a more concentrated set of managers around that. Given that transparency as well, we're not looking to have a high turnover portfolio. So the portfolio will be, as I said, more concentrated, but also have much less turnover in it. We're conscious that transaction costs can be a lot higher in a managed account structure than a managed fund structure. Brokerage will be many times what a fund manager will pay, and even buy-sell spreads on underlying assets and ETFs can also eat up returns. So cognizant of turnover, cognizant of transparency and how that can play into how an advisor uses the managed account and services their clients. So what does that mean? We're picking slightly different managers in the asset classes, but also looking to access things that let us have a bit more freedom. So how we've thought about alternatives is using a few of the traditional things that we see in portfolios, properties, hedge funds, etc., but also the MLC Inflation Plus Fund. And it's an important consideration for us. There are things that we still want to be able to bring to clients that aren't readily accessible on retail platform menus, such as inflation-linked securities or insurance-linked securities, more particularly derivative structures, certain alternative asset classes and managers that are only institutional access. So the MLC Inflation Plus Fund lets us actually do that in a way that works together with the rest of the asset allocation. So you roll forward one more slide. That role that alternatives can play and the focus on returns is, I think, an important part of the portfolio and an important part of the portfolio achieving its goals for clients in the long term. So having more levers to play, having access to things that are relatively unique in the market was a big part of our consideration is this portfolio going to deliver the outcomes that we know our fund series can deliver? So bring it all together a little bit. Do managed accounts work? Yes, we believe that clients accessing our managed account series will get similar outcomes to the managed fund series. They won't be identical. There'll be more volatility because they are more concentrated and will be slightly higher, lower turnover. But our backtesting and modelling suggests that over the long term, catering for those slightly higher tracking error and volatility measures, the probability of outcome will be very similar. We believe they're very efficient and they give advisors another tool in their toolbox for clients that want a different kind of experience, a more transparent kind of experience, but also giving the advisor more opportunity to tailor that outcome for clients using the platform functionality, but also the kind of assets the clients wants to see. So I might just pause there. I think probably one more point to make. As platform functionality continues to evolve, we see this space getting much more interesting as well. So we're starting to see more hidden menus and more unique assets on platforms. Managers like MLC can then bring more unique capability that isn't just general retail funds into that space and give clients the benefit of accessing institutional grade assets.
Thanks very much, Jason. That was excellent. Interesting to see one of our other presenters, Resolution Capital, included in the MLC portfolio there. So it's now my pleasure to hand over to Brett Sanders to look at the do managed accounts work issue from the perspective of compared to an advisor having a crack. Brett. Green button.
All right. Did something blow up? Or what? Just. Oh, sorry. Okay. Is that meant to be advancing the slide? As opposed to the small green button. Sorry about that. All right. Hi, everybody. Great to be here. It's, just thinking, it's sort of 15 months, I think, since I actually stood in front of a room of people and gave a presentation. So it feels nice to be back in this environment. So do managed accounts work, as Toby said, for whom, looking at it relative to what financial planners would typically or traditionally do today. When I talk to planners and ask them what their benchmark is for a managed account program going forward, what would they like it to achieve in their business, the sort of things that are coming up are those on the screen. They want better investor outcomes, so they're hoping that, by being able to move more nimbly, that they'll get a performance jump for their clients. They want more equitable treatment of investors. I think many planners feeling sort of a little bit guilty about the fact they can't deal with everybody equitably. I think the sort of FASEA obligations around fairness are starting to really factor into people's minds as well. And so people starting to think, how can I attend to this because there's something not quite right about the way I'm doing it today. People looking for less dispersion of returns as between investors. So if I've got two investors, ostensibly the same risk profile, why have I got this massive distribution of, well, not just two investors, you might have 20 or 30 investors of the same risk profile, and people are seeing a big spread in performance numbers and saying, well, that doesn't feel too good either. More efficient practices, advisory practices, there's a lot of hand cranking that can be expensive, hits the bottom line. People looking for less operating risk, the fact that you are hand cranking leads to errors, leads to compensation claims. Those are aspects of business that people would like to see diminish. Then better quality of working life for people, the colleagues in a financial planning practice. I had one guy in Melbourne say to me the other week, if I ask my back office team to do another full rebalance in the next 6 months, there's going to be mutiny. That they're just weary of the constant pumping out of ROAs and not really feeling any warm glow about that whatsoever. That not feeling that the client really appreciates it that much, that it's a compliance activity and who's winning out of it. And so there's a certain degree of world weariness around that. And then finally, people wanting a better experience for investors. And that experience is not just performance as per the first point, but it's also just easier to own the service. I can sort of don't have to worry about it as much. I'm not dealing with as much paperwork. I'm not put under pressure to get things back to you all the time. So using that set of criteria, the answer is yes. Managed accounts do work. They do all of those things, and they do so because of the very structure of it, because of this ability to invest people in a model and to rebalance those models, everybody at the same time, and so you get the same experience, same price, same access to investment opportunity, and so those issues that we've targeted there are being delivered. So focusing on that first one, one of the things we wanted to do at Philo, this question about being able to execute more quickly, leading to better investment outcomes. Is that real? And as Toby said, the counterfactual is advisors actually doing it themselves. So this exercise here, a busy slide, but let me talk you through it. What we wanted to do is to take 20 years of returns, market returns. We've divided that 20 years up into 834 rolling 3-year periods. So we've got, this sequence of 3-year measurement periods, where for each measurement period, we're taking a strategic asset allocation of a balanced portfolio and just rolling it through that period and saying, what did that return? We lock that in. That's a strategic asset allocation rebalanced 4 times a year. Probably generous in terms of what a planner might do today if you're a proponent of SAA, to rebalance 4 times a year. What are we comparing it to? We're actually looking at a process where this is all just about asset allocation, nothing about security selection. So for each of the 834 periods, we're running 1,000 different iterations, so 834,000 altogether, and that 1,000 different iterations involves setting up a sequence of asset allocation changes where we've dialed up the success rate to 56%. So we're saying that over a 3-year period, we're going to have 18 different interventions in terms of asset allocation. 10 of those interventions are going to add value and 8 aren't. They're going to subtract value. So we've applied that over that 20 years of history. The 1,000 iterations is about adjusting the sequence with which those decisions are made. So what order did the value-added decisions come in, and at what point during the 3-year period did they land? Did they all come at the beginning, or did they come at the end, and we use the technology to mix it all up? So what you get after all of that is an SAA benchmark, if you like, then this sequence of DAA processes, 6 per year, these readjustments, and we start to have a look and see what sort of outcomes we get. Over that 20-year period, this is from 1st of January 2000 to the end of 2019, the value added through that process was 1.1%. And I don't think we should obsess about that number too much, but that was the alpha where, 56% rate, 1.1% added value. What's interesting is what happens if you take that value-added set of decisions and then you lag the implementation by different time periods. So if you lag it by a week, so the decision that we were made in January 2019, on the 1st of January, we lag it by a week, or we lag it by 2 weeks, 3 weeks, 4 weeks, etc. And what happens to the outcomes? And this is it in a graphical form. So each of the little orange dots is one of the 834 periods, and we are looking at across the top line there, the horizontal axis, 1 week, 2 weeks, 3 weeks, out to 13 weeks delay, and you're looking at the percentage of the alpha, the 1.1% that was lost when you had a delay. So if you go out to 4 weeks, you'll see that there's approximately 50% of the alpha that would otherwise have been generated if you could have implemented immediately, 50% of that gone because of the delay. And intuitively that makes sense. You have a view, if this was an active sort of set of decisions, you have a view on where a market is at a point in time, you make your decision. But if you say, well, wait 4 weeks, well, the market could have done anything by then, couldn't it? So intuitively, it makes sense that you're going to lose some of that alpha if you defer the decisions. And so 50% is lost in a 4-week time frame, 13 weeks in sees you lose about 80% of the value. So let's think about that in terms of an advisory practice. Your investment committee makes a decision about asset allocation, says, yes, we're going to go risk on, risk off, whatever it might be, 5% out of equities, it's going into bonds, and let's go start writing the ROAs. So you've got to write them, you've got to send them out, people have got to sign them, you've got to get them back. I guess as good as it would ever happen, you might complete all of that in 1 or 2 weeks, but many, many times that's going to be, months before that process is concluded. And in that time, 80% of that alpha is gone because of the lag. What does that mean when you translate it to actual dollars? Well, on the left-hand chart, what you can see is that relative to that quarterly SAA rebalance process that we saw, we added 1.1%, which equated over a 20-year period to $361,000 in additional value for that client. But with the 3-month lag, if that was the average lag in execution, $295,000 of that alpha disappears. You give it back. So the ability to execute promptly emerges as critical. Now, this is a sort of a set of numbers that we've set up with lots and lots of iterations, hundreds of thousands of track records randomly generated to so we're not back testing some mythical fund manager, and saying, well, compared to that one individual manager, how did we go, relative to the planner? 834,000 track records with a set of real market data. You lag the decisions, whatever the alpha is. If we dial a success rate down from 56% to say 52%, you're still burning 80% of the alpha. It's just all the numbers shrink a bit in dollar terms, but you're still burning about the same amount of the alpha. So the ability to execute quickly is critical. Managed accounts do solve that problem. So I think for us, we'd say they work. It accords with our practical real-life experience of dealing with planners and a variety of portfolio managers who are making their decisions about execution, and being able to see them move nimbly and actively is generating real-world benefits for their clients and for them. So look, I'll stop there and hand back to Toby. Thank you.
Thanks very much, Bruce. Look, in the interest of time, I'm not going to go through this exercise of saying what would the issue of do managed accounts work mean to you, but it's an important question. And what we've tried to present today with the help of Jason from a fund manager's point of view, with the help of Rob Silva from Sqm from a researcher's point of view, and from Brett's point of view, from an advice point of view, are three different perspectives on whether managed accounts might work. So I'd encourage you to go back and reflect on that for yourself. This data, Brett's data, shows that delay is actually a real significant cost to clients. If you ask yourself, I'm making this recommendation, I've got a best interest test as an advisor, what are the things I can put in a statement of advice which says, I am making this recommendation because X, first and foremost, is it's appropriate for you, it'll meet your goals, so on and so forth. But the question of is it cheaper comes a long way down the list, because these other issues of you will get a better outcome really are true. We're actually going to be doing more work specifically in this area, so I look forward to sharing that with you in the future. So now please join with me in thanking Brett, Jason Comodina and Rob De Silva.
Thanks very much, gentlemen. I thought that was really quite interesting. Brett and I both support the same football club, and I know it's the wrong state. We both support the Collingwood Football Club. I'd like you to turn your attention of you and your team to the same degree of analysis, please, to solve Collingwood's upcoming season. That'd be much appreciated. Now, we're 2 sessions away from afternoon drinks, and we're 1 session away from afternoon tea. Traditionally a bit of a graveyard session, but I assure you that we're going to... But I assure you that won't be the case, because we'll cut into afternoon tea's time to make sure the next presenters have got the full amount of time, because it's a fascinating topic. Outside of the top 20 Aussie equities, what options have we got? And our moderator, I should say, who will come on stage and then present the rest of the team, the panel, is Steve Furness of MGD. I did a little bit of research on Steve's background, and it's interesting. Not only is he an advisor, so he's at the pointy end, he's spoken to clients, he's a CFP, he's an accredited life risk advisor too, which is wonderful to see. So he's actually had real conversations in real time with real people, but he also, in his role, spans, not only the other advisors in the firm, but the researchers and the investment partners in his role. over 30 years of advising and dealing with clients and investment matters. So please welcome Steve Verness to the podium. Thank you.
I'll do that. That's my job, isn't it? All right, I better read it. Welcome, everyone. Thanks for your attention in apparently the graveyard session. And I do need a coffee, so we'll stay on time. I really don't know why Toby asked me to moderate this session, but I'll do my best. Where is Brad? Brad? I don't know these guys, really, other than a couple of minutes, so come up, Brad. And I'll read your bios. Who's going first, Toby? Brad's off first. Well, I'm sure you got your bio sheets here. Brad Partridge, Macquarie Lead Portfolio Manager. Brad's is the Lead Portfolio Manager for Macquarie Investment Management's Australian Equity SMA Model Portfolios. Brad's been at Macquarie for ever and a day, 20 years almost, and has managed SMA portfolios since 2007. And we have Justin Warner, is that correct? Yes, from Elston, Portfolio Manager, Australian Equity and Multi-Sector Investment Teams for Elston Asset Management. 20 years industry experience and CFA as well. Very good. So, I'm not a CFA. I feel inadequate. So this is clearly this sector, X20 Australian equities, is quite a pointy end part of investing, rather than some of the broader discussions we've had today. Whilst I might chair MGD's investment committee, along with support from a number of asset consultants and research providers, I was first authorised in 94, so what's that, 20 odd years. And I used to go to fund manager sessions, and I'm sure, like all the practitioners here, you'd write down a couple of stocks that they talked about and you'd go and buy them yourselves. And it would end in tears. So, because I worked out, by the time they're telling you about a great stock and you go and buy it, they're on the way out. So, so I decided a long time ago, especially in this sector, to just leave it to the experts. So it's good to have a couple of experts along today. I guess from a practitioner's point of view, that's the key audience here. There's a lot of fund managers here, but the key audience is people like myself and my colleagues and the industry colleagues. I guess this part, the X20 Australian equities, is all close to our heart, you know, home bias and all that sort of stuff, and we like hearing the great success stories of Australian businesses coming up out of micros into smalls and all that. A pretty interesting sector. So I think for me as a practitioner, it's from a total portfolio strategy, how, you know, we just had MLC talking about, you know, their growth, SMA or managed fund, how we might think about the role of X20 from a total portfolio point of view. And then also we have plenty of just looking at domestic equities as a sleeve or a strategy, how we might sort of play that top 20 versus X20 and that sort of thing. So from my point of view, that's what I'd like to get out of this session. I've written down a whole heap of questions, so when we come back up for Q&A, if you do have questions, then certainly put your hand up. Thanks, Brad.
Thanks, Steve. Steve said I've been at Macquarie for almost 20 years, but I'm only 29, so I don't know how that's possible, but anyhow. Look, it is really great to be here. I live in Sydney, and today was the first time I'd been on a plane for 12 months, so hopefully, it feels like a sign that we're starting to get back to normal. So, what I wanted to do today was just give you a few thoughts on the X20 part of the market, and why we see great opportunity in the X20 part of the market, but also the broader small cap part of the market as well. Disclaimer. So first of all, I'll just give you a quick overview of Macquarie's capabilities within the direct equity SMA space. So at Macquarie, we've been managing direct equity SMAs for close to 20 years. And it's part of a broader Aussie equity capability that we've got. So we manage close to 20 billion in Aussie equities. So we're one of the larger managers of Aussie equities in the market. And within the direct equity SMA space, we manage about 550 million for our retail clients. Obviously, we're well resourced. Pleasingly, we've got some good ratings for our core Aussie equity SMA with Zenith and Lonsec, and we're very pleased to have won the IMAP award for the last 3 years for the Aussie equity small cap SMA as well. So just moving through to some of the strategies that we run, both within the SMA space, but also the managed fund space for our clients. And you can see here, this is just illustrated in terms of the risk versus return of the different strategies that we run. And what you can see here is we've got a flagship Aussie equity strategy, which is our core Aussie equity SMA, which is the SMA equivalent of our managed fund, which is the Australian Share Fund. It then steps up in terms of risk and return, and through and down in terms of market cap. So we run an X20 SMA, which we've been running for about 7 years, a small cap SMA, which is the equivalent of our small companies fund. And for those that want to have some fun, we've got a micro cap fund as well, which is the emerging companies fund. We don't offer that one within the SMA world. It is a little bit hard to implement. So how do we manage these SMAs? We run what we call a systematic approach, which is a fancy way of saying a quantitative-based approach. And then we apply what we call a portfolio manager overlay. So we fully appreciate that we've got a quantitative model, which is great, but it doesn't understand that COVID exists. It doesn't understand that Donald Trump exists. We need to apply our systematic model to the real world. So we screen for a few particular factors in the market. We're looking for good quality companies with good positive operating momentum, trading at reasonable valuations. And then we put together a well-diversified portfolio of 30-odd securities, which is has good appropriate position sizing and diversification across various sectors and themes. So overall, a quality-focused approach, which we think is the right way to go when it comes to putting together direct equity SMA portfolios. So hopefully that gives you a sense of who we are and what we do and how we do it. Now I want to get into the interesting stuff, which is the X20 opportunity and why you'd be thinking about investing in the X20 part of the market. So I think one of there are quite a few reasons why you'd invest in the X20 part of the market, but one interesting reason for us relates to the life cycle of companies. And what you can see on this slide is a stylized look at a typical company life cycle. And you can see that obviously most companies start out in the launch phase. Plenty don't survive, but for those that do, over a period of time, they move into a growth phase of their life cycle. And that growth phase might go for a few years, it could go for a few decades. It really depends on the company. But at some point, that company will start to mature, and then it's got two options. It can either move into a decline phase, which is unlikely because the boards and management teams want to find some growth, so they end up reinventing themselves in terms of whether it be through M&A or extensions of their product and service offering. So why is this interesting? We think that we can group, as a very broad generalisation, we can group companies across the ASX into different parts of the life cycle. So if you have a look at the bottom of this slide, you can see that for the micro cap and small cap part of the market, typically a lot of those companies are find themselves in the launch and growth phase of their life cycle. As those companies start to grow and succeed, they become bigger, and typically the mid-cap and X20 part of the market is where we find those good growth companies. When you have a look at the top 20 part of the market, that's where you find a lot of these mature businesses. And what you can see on the right-hand side is we've just had a look at each of the companies within the ASX top 20. And as a very broad categorization, allocated each of those companies to a particular part of their company life cycle. And unsurprisingly, we've got the big four banks, which are mature businesses. Obviously, given the industry structure, it is challenging, and the domestic focus, it's challenging to find growth. We've got the big retailers, particularly in supermarkets, again, a mature industry. You move through to the various resources stocks, whether it be through mining or energy, and again, quite mature companies generating great cash flow, but also very cyclical in nature. And then you move down to a handful of various industrial companies at the bottom of that list. And what you can see there is we would argue there's only a handful of genuine growth companies sitting in that top 20 part of the market. So why is that relevant? We would say, and just to be clear, we're not saying that the top 20 part of the market is a bad place to invest, but we think that for clients that are looking for good income from their portfolio, then by all means you should be looking at these mature businesses, because they don't have that organic growth optionality within the business. The right thing for them to do is to give that capital back to shareholders through big, fully franked dividends, as opposed to reinvesting it back into the business, into projects that won't return a good return on invested capital. So if you're an income-focused investor, by all means, some great mature income-generating businesses to look at in the top 20. But if you're a wealth accumulator, if you're looking to generate most of your total shareholder return from capital growth, capital gains, as opposed to dividend income, then we really think that stepping outside of that top 20 part of the market into the parts of the market where you find those companies that are in that growth phase of their life cycle really opens you up to some good opportunity for investment. So let's look at a couple of case studies, and I've put up Afterpay, which is clearly a stock that divides the market. And I'm not here today to say whether Afterpay is a buy or not at these levels. The reason I present Afterpay today is because it really is a great example of a company that now sits within the top 20, but has come a long way in a very short space of time. So you can see there that Afterpay, obviously a global player in the buy now, pay later space. This company was about only 4 years ago, this was a 300 mil market cap. It's now close to a 40 bill market cap. And over that period of time, it's moved through the ASX 300, into the 200, into the large cap 100, and in December of last year, it moved into the ASX top 20. This is a great example of a company, if you're looking outside the top 20, then obviously you can find opportunity. You can see the blue dots and the orange dots on this slide. That represents the buy and sell points for our small cap SMA and our X20 SMA. Pleasingly, we've been able to generate some good returns by owning Afterpay in both of those SMAs. We have exited Afterpay for our X20 SMA. It is now a top 20 stock, so we don't hold it any longer. But clearly a great example of the opportunities that are available if you do look outside of those mature top 20 businesses. So you're probably sitting there saying, well, that's really interesting, Brad, but I've missed Afterpay, and everyone knows about Afterpay. What are some other ideas? So I thought I'd just present one more, which is IDP Education. So, and this is actually a stock that I presented here, I think, at the last conference about 15 months ago. And pleasingly, it's performed well since then. So IDP Education is a student placement business focused on placing students into tertiary education in Australia, Canada, the UK. And this is another great example of a business that really offers good growth opportunity. It's a company that screens well in our a process across quality and sentiment. And you can see that it's a business that we've held for a long time in both our small cap SMA and our X20 SMA. This is a company that has migrated into the 300 and then it graduated into the 200. And in December of last year, this company moved into the large cap ASX 100. So it is a company that, a position that we will be exiting in the short term for our small cap SMA because it's no longer a small cap company. But you can see, again, some strong returns. This is a company too which has obviously faced some shorter term issues around COVID. Clearly there's not a lot of international students certainly coming to Australia at this point in time. But despite that, it's a great illustration of a business that is a leader in its market, is reinvesting its cash flows back into the business for future growth. And it's another good example, we believe, of a quality business which is suitable for growth-seeking investors outside of the top 20 part of the market. So just to summarise from our perspective, we believe that the top 20 part of the market is great, particularly for income-seeking investors that are looking for those cash-generative, mature companies. But for those wealth accumulators out there that are looking to generate good long-term capital growth, we think that there's some great opportunity in the small cap and X20 part of the market. How do we take advantage of that? We run quality-focused and well-diversified direct Aussie equity SMAs, and we believe that positions our growth-focused clients well for long-term growth and capital returns. So I'll leave it there and hand over to Justin.
Thanks, Brad. Hello, everyone. So I'm going to speak for probably the next 10 minutes or so. I'll provide a quick background on sort of Elston Asset Management, and I'll touch on sort of how we look at investing outside of the top 20, where we're currently seeing some opportunities in the market at the moment, and then finish off with a few current holding examples. So Elston Asset Management's a local Brisbane-based funds management firm. We were founded in March of 2011, so we're actually 10 years old this month. So I'm sure there'll be a party somewhere. Today, we manage just over 2.6 billion in FUM, of which we manage that across Australian equities and multi-sector products. So within Australian equities, we run an Australian large companies fund, which focuses on the top 100, and an emerging leaders strategy, which focuses on the market outside of the top 100. We run a team-based investment process. So we have an investment team of 10 individuals, which comprises 4 portfolio managers, 9 CFA charter holders. We really see ourselves as being long-term fundamental investors. So we really see ourselves as being buyers of businesses rather than traders of securities. So we try to take the time to understand the underlying fundamentals of each of the businesses and where those businesses will be in the next 3+ years. We manage a style-neutral process within the Aussie Large Companies Fund. So we're really looking for aspects of growth and value. And we're active, benchmark unaware investors, which I think is probably best reflected in the next slide. So here we have the index weights for the ASX 300 in the dark grey. And then over the top of that, we've overlaid a series of bars which represent the current portfolio holdings within the Australian Larger Companies Fund and the Emerging Leaders Fund. The size of the bars represents the portfolio weight, and they're colour-coded depending on sector. So I think there's a couple of things we can take from this slide. First of all, the one thing that we're all probably already aware of is that the index is highly concentrated. So if you look at the top 20, it accounts for just 7% of the names in the index, but it accounts for close to 55% of the index weight. Within that 55%, about 60% is accounted for by just two sectors, being financials and materials. So the index is highly concentrated across a select number of names and a select number of sectors. So what we do is we try to take an active benchmark unaware approach. And you can see this really in the relative size of the bars compared to the index weights. So we're active across the market. And we think this opens up a whole new set of opportunity sets. Within that 300 index, there's an additional 280 businesses outside of the top 20. Outside of the 300, we think there's an additional 200 businesses which are investable. So we've taken our universe now to 500 businesses across both portfolios. And then finally, the thing that you can take from that slide is the distribution of the bars, along with the colouring of the bars, can tell you that we're actually seeing a lot of opportunities across the market and across sectors. So where are we seeing some of those opportunities? So we have an overarching philosophy that we apply. With every investment, we look at it with regards to the same philosophy. We're thinking about preservation of capital, long-term fundamental investing. But similar to Brad's slide on life cycles, we don't see the business characteristics across the market as being consistent. Within the top 20, we have our largest, most mature businesses. So here, we apply more of a value-based bias. Within the rest of the top 100, then we still tend to have fairly large, fairly mature businesses. They tend to have reasonable levels of profitability, reasonable levels of return on equity, reasonable levels of gearing, various degrees of growth. So here we apply a style-neutral process. We're really looking for a combination of value and growth. So at the moment, we're really seeing opportunities within energy and travel-related names. So both of these exposures have been in the portfolio for some time, but they've both been increased going back about 12 months. So March of last year, we increased our exposure to energy based on the pullback in the global oil prices. In a similar fashion, we increased our exposure to travel-related businesses on the back of COVID disruptions. Now, outside of the top 100, we really see this as a different universe. So generally speaking, in this small cap realm, we have businesses which are younger, less mature, less proven business models. They have lower levels of profitability, if profitable at all. They have lower levels of return on equity. They also tend to have higher levels of gearing. So we generally see this small cap realm as being lower quality. We think in here we can generate excess returns and lower risk through simply focusing on higher quality, more predictable businesses with strong growth outlooks. Here we're really seeing opportunity in a series of retailers. So we think Lovisa, Nick Scali, Beacon Lighting, Baby Bunting. These are all very well managed businesses. They all tend to be market leaders. They all tend to have competitive advantages, scale advantages, and they have the ability to generate excess growth through store rollouts. The other area in this market where we're seeing opportunities is through a series of tech-based disruptors. So here you think about PushPay, Ordinate, Hub24, NetWealth. These are all businesses that are supplying a better mousetrap. So compared to their competitors at the moment, they're providing a product that has a stronger value proposition, a higher degree of functionality, and we believe the ability to continue to take market share over the longer term. So in this small cap space, we're really focused on the quality growth aspects of the business. We think this is the most appropriate way to manage our exposure within the X100. But the other thing that we see as an advantage and a benefit to clients is the broader aspect across the portfolio. So by doing this, we attain greater diversification across styles. So value in the top 20, value growth style neutral through the rest of the 100, quality growth in the X100. The other thing that we obtain is diversity across sectors. So the sectors that are more prominent in the top 100 are not the sectors that are more prominent in the X100. And then where we're seeing opportunities, the sectors that we're seeing opportunities in the top 100 are not the same as the sectors where we're seeing opportunities in the X100. So just drilling down into a couple of examples. So the first one comes from within the top 100 space. It's Sydney Airport. It's a company we're all familiar with. We added this into the portfolio in March of last year on the back of the COVID disruptions. Now for us, this is really a story of short-term versus long-term, and potentially an example of the benefits of being long-term investors. So in the short term, we get it. This business is highly disrupted by COVID. We understand that. So we initially went and looked through the balance sheet of this business. We wanted to make sure that Sydney had the balance sheet strength to be able to survive the next 2 to 3 years, and we think it does. On a longer term basis, we really see Sydney as being a high quality, long life asset with reasonable growth prospects. So we're attracted to that. We think we've been fairly conservative with regards to our assumptions. So we model passenger numbers. We're expecting passenger numbers for Sydney Airport to get back to FY19 levels in FY24. So that's not this year or next year or the year after that, but the following year, for passenger numbers to get back somewhere roughly where they were in FY19. And if this business can achieve that, then we think it's capable of generating strong excess returns over the next 3 years. My second example comes from outside of the top 100. It's one of our small cap holdings within the Emerging Leaders strategy, and it's Audinate. So Audinate's a good example of what we're looking for in that lower quality market, in that X100 space. Audinate provides digital network solutions to the AV industry. It basically allows you to remove the cables. So we think that's a strong value proposition. It operates in a large global market. It's the market leader. So it's incorporated in 8 times more OEM products than the number 2, which is generating strong network advantages. So summing up Audinate, we have a business that provides a strong value proposition in a large addressable market with a low level of penetration. It has competitive advantages, and we believe the ability to grow at robust rates over the next 5 years. So finally, this slide just lists some of the industry recognition that we've received and our platform availability. But really sort of just summing up, we continue to think that exposure to the mid-caps and small-cap space provides benefits to all portfolios through the opening up of additional opportunity sets and the provision of tangible diversification benefits. And at the moment, we remain very positive with regards to the outlook for both our larger companies fund and our emerging leaders strategy, given that we're seeing strong longer-term opportunities right across the market. Thank you.
Can you bring up Brad's 4th slide? Can we go back? There's quite a good slide there that might help. All right, good. That one. I think that's just a good landscape of the different parts of the domestic equity market. So our firm, MGD's, taps into Morningstar research and a couple of others. But just on the core strategy, and Elston, I know you run a large cap strategy. Just looking at the portfolio characteristics of Morningstar, just put out their equity wrap a couple of weeks ago. Most of the active managers are 36, 46, 50 stocks for that core portfolio. So in terms of X20 parts of a core strategy, can you give us a flavour, both of you, of how the decision making around sticking mainly in the top 20 versus making decisions outside the top 20 for that core strategy?
Yeah, I think it's interesting because the portfolio construction process, I think, is different for the core type model as it is as opposed to the X20. In a vanilla Aussie equity core type strategy, you're really thinking about the awareness to the benchmark. You're thinking about you'll hold stocks that you might hold for tracking error considerations. It might be that you hold a particular company at a benchmark weight or even an underweight, but you need some exposure. Whereas I think in the X20 and the small cap part of the market, the way that we think about portfolio construction is certainly around less so about the index, and we run a higher tracking error, and more about if we're going to hold a company, it's going to be an active overweight position. So that's, I think, hopefully that's where you're.
Yeah. So how many stocks do you hold in that?
Yeah. So across all the SMAs, we understand that if you're sitting down with a client, you can't just have this laundry list of names. You can't hold. So in our managed funds, so in the small companies fund and the Australian shares fund, we run 60 to 80 positions. Mm-hmm. But across all the SMAs, we run 25 to 35. It's just, I think it's pretty hard, given the transparency available to investors, to have a long list of stocks, and also in terms of the minimum investment size as well. So if you come in with $50,000, you don't want to have 80 stocks because then you've got half a CSL share, which is pretty hard to do.
Yeah. Justin, how does Elston run that?
We're sort of similar in that we run quite concentrated portfolios. So whether it's the Australian Large Companies Fund, where, traditionally we sort of have 20 holdings, somewhere between sort of 20 and 25, or whether it's the Emerging Leaders strategy, where we sort of have similar numbers between 15 and 25. And it's really all about where we actually see the value. So, as I mentioned, we're benchmark unaware. We don't hold a business because it's in the benchmark. We hold a business because we think it's a decent, reasonable business, and it's got ability to add value to the portfolio. And, we sort of add that into the portfolio on that basis. So it really sort of just comes down to where we're seeing the value. We do some attribution analysis and sort of risk monitoring and risk management around sort of the value growth biases within that larger companies, and we sort of try to stay that style neutral approach. We will sort of drift occasionally into a little bit more value or a little bit more growth, but it's really just sort of being benchmark aware and trying to create the best portfolio that we can create for our clients.
Very good. So in the more exciting part, the small caps area, just quoting the Morningstar, it was a pretty wild ride. That's what the article's called, the wild ride of small caps last year. The index, small cap index, was down 40 and then up 57.1. So it's pretty hectic year, but it actually finished 2020 well ahead of the large cap indexes. So, but they do note that the JobKeeper, job seeker incentives really did benefit a lot of the small cap market, and sort of intimating at how what might happen when that comes off a lot. Have you got a view on some of the small caps that have benefited out of all that incentive money?
Yeah, well, we've certainly had a few in the portfolio. So some of those retailers that I've mentioned. So if you sort of look at the same store sales growth for Nick Scali and Beacon Lighting, then they've just been off the charts, really. So, we don't expect that to continue for sure. In most of those models, we're assuming that same-store sales growth will be positive this year, and then potentially, or most likely, negative next year, and then potentially even negative the year after that as well. So, we do understand that there has been some clear beneficiaries of COVID and some clear losers from COVID, but we sort of just continue to take that longer-term view. And those retailers that we've got exposure to at the moment got other growth avenues as well. So we still think they've got the ability to continue to grow at robust rates over the longer term.
Yeah, I think we're of the same view on all that. I'd probably just add, it wasn't, from our perspective, just JobKeeper and JobSeeker. There was obviously a lot of broader stimulus. There was the early release of superannuation. There was a lot of money that's typically spent on overseas travel, which wasn't being spent. So the consumer certainly felt that they had a lot of money in their pocket, and that benefited the small cap retailers in particular.
Yeah. We are in a managed account conference, and we had MLC. I couldn't read all their line items to tell what they were up to, but I had a look at 3 different growth or aggressive SMAs from issued by mainstream asset consultants, and one had 40% domestic equities but 0 dedicated small cap manager, right? And the other 2 had about 4% dedicated small cap. What like practitioners and clients sort of love that sector, but what are the asset consultants, the big end, running big diversified portfolios? What are they? Why would they have a 0 allocation to the small cap and just run an all cap sort of strategy? You got a view on that?
Well, from my perspective, as I went through in my presentation, there's good growth opportunity in small cap. So I guess it depends on how you access that, whether you get it through, whether you think you can access it through an all cap strategy. But we would argue that a specific allocation to small caps is certainly appropriate. And then the question is, how do you actually achieve that? Do you do it through a direct equity SMA, which we offer, or a managed fund? And I think obviously the managed fund is an easy way to do that, but it doesn't offer the transparency that some clients are seeking. But by the same token, we also find that a lot of advisors and their clients don't actually want the transparency as much in that small cap part of the market, and having a direct equity small cap is not something that they're necessarily seeking. So I think it really depends on the individual.
Your view, Justin, or how do you run? I know you run it.
Yeah, it's probably pretty similar. It's really just, I guess, the issue when you start going into small cap, and depending on how far down the market capitalisation spectrum you go, but liquidity is always an issue, and then execution becomes an issue on top of that as well.
Now, I've got a couple more questions, but are there any questions before we break for coffee?
Question?
Just on your slide there, Brad, and I'm sure you've got a view, Justin. You even suggested as much as in your presentation. You are happy you can run an SMA of individual stocks up to or down to a certain market cap level, and the micros are better through a managed fund structure, and that managed fund might be part of a broader SMA anyway. Where does that start and stop?
Yeah, we're certainly confident that we can run small caps in a direct equity SMA. We've been doing that for several years now, and we're confident that we're getting some good outcomes for clients. Obviously, micro caps. So when we think about micro caps, we're looking at sub 500 mil market cap. Sometimes these stocks might go a day or two without even trading. So one of the challenges for us, and obviously we straddle both the managed fund and the SMA world. Within the managed fund world, we have for our funds, we have an internal dealing team. So we have 3 dealers that just execute for our funds, whereas when we run an SMA, we're obviously giving that model portfolio and those trades to a platform to implement for us. So when we're running our managed fund, we can see the execution that we're getting, and we know that the brokers that we're dealing through, we can access lines of stock, etc. In the SMA world, where we're giving the platform that responsibility on our behalf. So the challenge for a small cap equity, direct equity SMA, is having the confidence that the platform that it's being implemented through has the appropriate broker networks and execution capability to get good outcomes for clients.
And Justin, how would Elston run the implementation of microcaps?
Yeah, that's actually quite challenging, I think, because we don't really have the separate small cap and then micro cap fund. So we really just have an emerging leaders strategy, which goes down to sort of market capitalizations of 150 mil and above. So even when you start getting down at that end, you sort of the execution liquidity can become pretty thin, so execution can become pretty hard. So, we do some of that internally, and then the rest of it's outsourced, but it does take a fair bit of management sometimes.
All right, I've got a flashing light here, which means...
Well, I've got one question, which sort of touches on your slide, Brad, which sort of showed. Perhaps we could go to it, Steve, which is the slide which showed revenue growth and revenue, profit, and cash flow. Big green one.
Big green one.
Yep. Yeah, that one. So, I mean, what this is saying is that growth companies are typically cash consumers to fund that growth. Do you see a problem? Do you see a problem with those companies over the next couple of years raising the capital that they're going to need? You talked about store expansion, for example. That's pretty expensive.
Yeah, you would hope that most of these good quality growth companies are able to generate and fund most of their growth internally. So I think the key difference that I was trying to call out between those growth companies and the more mature companies is that they're both generating good free cash flow, but the mature companies are sitting there saying, well, we don't have any great internal growth opportunity in front of us. Yes, we could put that capital back into the business, but the return on that invested capital is going to be pretty small because we don't have any great growth capital projects to invest in. Whereas a growth company is a high growth company in that mid-cap space is hopefully generating that strong free cash flow as well. But they've got a whole bunch of different capital projects that they could invest in to generate a good return on that invested capital. And as a result, those cash flows are better off being reinvested back into the business. Whereas for the mature company, if they can't generate good return on invested capital, then you'd hope that it would come back to shareholders through dividends.
Justin, you got any further to that?
Not a huge amount. We probably prefer not to invest in something that's not profitable. So, for us, it really all comes down to the quality of the business, and part of that is the free cash flow that they're generating and being able to spin off, but also the predictability of the cash flows as well. So, we'll only invest in an unprofitable business if it still has the ability to fund itself and fund its growth through its free cash flows. And so if anything else, we just sort of try to avoid, really.
Very good. All right, folks. I do thank you, Justin. I bought some Sydney airports, saying I didn't buy anything. I did buy some at $4.70 last year.
Yeah, well, I guess that's the other thing. Right? So I know in your introduction you said don't take any stock tips, but hopefully being long-term investors and identification of high-quality businesses, those two will still be in the portfolio in another 12 or 24 months.
Very good. All right, folks. Coffee time. Thank you, Brad. Thank you, Justin.